Welcome back to the channel, Future Financial Wizards. If you're someone who's living the dream with pension income, Social Security, and dividends making up your retirement, you're in for a treat today. We're diving into some game-changing strategies to minimize taxes and even grow your dividend income without limits. Yes, you heard that right. And don't worry, I'm going to make it simple so you don't need a PhD in finance to understand it. So grab your coffee, your favorite snack, and let's get down to the nitty-gritty of making your retirement income work smarter for you, not harder. You don't want to miss out on this, trust me. By the end of this video, you'll be the retirement planning genius you were always meant to be. If you're enjoying the content, go ahead and hit that like button, subscribe for more tips, and definitely share this video with your family and friends. Because who wouldn't want to pay less in taxes and grow their income, right? All right, before we dive into the strategies, let's quickly break down what we're working with here. Your retirement income comes from three main sources: pension income, Social Security benefits, dividends from investments. Pension income is like that steady paycheck that you don't have to work for anymore. Nice, right? Social Security is the government's way of saying, hey, thanks for all those years of working hard. And dividends. Well, that's the reward for investing smartly and getting paid to own shares of companies. Sounds pretty sweet, doesn't it? But here's the thing. While this income might sound like a financial paradise, there's one pesky little issue: taxes. And when it comes to retirement income, taxes can sneak up on you, eating into what you thought was all yours. But don't worry, I'm here to help you keep more of that money in your pocket. So let's break it down. First, let's talk about taxes on pension income. Pensions are typically taxed as ordinary income, which means the amount you withdraw from your pension is taxed at your regular income tax rate. This can sometimes push you into a higher tax bracket, depending on how much you're withdrawing. Imagine you're at a buffet. You go up with your plate, and you're feeling great, ready to load it up with all the goodies. But the server behind the counter says, "Whoa there, that's a big plate you've got. If you want more, you've got to pay a higher price." Yep, that's how pension income taxes can hit you if you're not careful. Now, let's talk about Social Security. The beloved Social Security check. But did you know that up to 85% of your Social Security benefits can be taxable if your income is too high? Yikes. This is one of those hidden retirement traps you don't want to fall into. It's like getting a giant bowl of ice cream only to find out it's melting faster than you can eat it, because taxes are eating up the sweetness. But don't worry, I've got some tricks to slow down that melting process. And then, we have dividends. The good news is that qualified dividends are usually taxed at a lower rate than regular income. But here's the catch. If you're in a higher income bracket, your dividends could get taxed at that higher rate, which can still cut into your profits. So while dividends are your golden goose, you want to make sure you're handling them properly to avoid losing too much of the golden eggs to taxes. So now that we know what we're up against, let's talk about how to minimize those taxes and make sure you're keeping more of your hard-earned retirement dollars. Here are some key strategies you can use. The first strategy is to adopt a tax-efficient withdrawal strategy. Here's the deal. You don't want to take all your retirement income from taxable sources at once. This could push you into a higher tax bracket, and nobody wants that. Instead, consider taking tax-deferred income first, like from traditional 401(k)s or IRAs. This way, you can leave your tax-free Roth accounts and dividends to grow longer without being taxed. It's all about mixing it up. Think of it like assembling the perfect, balanced breakfast. You wouldn't eat only pancakes, right? You need a little protein, some fruit, and yes, a little syrup too. Next, let's talk about delaying Social Security. If you're able to wait until your full retirement age, or even up to age 70, your Social Security benefits will increase. Not only that, but you'll also reduce the chances of having too much taxable income from Social Security in the earlier years. It's like holding off on your dessert until after the main course. Sure, you're a little hungry now, but trust me, the payoff is worth it. And you'll thank yourself later when that extra dough shows up in your account. Consider putting more of your income into tax-advantaged accounts, like a Roth IRA. With Roth IRAs, you don't pay taxes when you pull out the money. So, the more you have in there, the less you'll be subject to taxes when you need it the most. Now we're talking. You could have tax-free growth on your investments, and that's the kind of magic you want in your portfolio. Okay, let's not forget about dividends. You want to maximize that sweet dividend income while keeping taxes low. And here's the secret sauce. Focus on qualified dividends. Qualified dividends are taxed at the lower long-term capital gains rate, which is a sweet deal. Think of it like buying discounted tickets to an amusement park. You're still getting in, but for less money. The trick is knowing which stocks to choose for those qualified dividends. Stick to blue-chip stocks and dividend ETFs that meet the qualifications, and boom, you've got a solid dividend income plan. And here's a bonus tip for dividends. You can also do tax loss harvesting. This strategy allows you to sell investments at a loss to offset any taxable gains. Essentially, you're shifting the tax burden, which can lower your taxable income and make it easier to keep your dividend income growing, uninterrupted. Now, let's talk about how to grow your dividend income without limits. You want your dividends to keep growing year after year, right? Here's how to make sure that happens. One of the best ways to grow your dividends is to reinvest them using a dividend reinvestment plan, DRIP. This allows you to automatically reinvest your dividends to purchase more shares of stock, which means your dividend income will grow exponentially over time. It's like compounding interest on steroids, but in the best way possible. Focus on stocks that have a history of growing dividends. Stocks like Coca-Cola, Johnson & Johnson, or Procter & Gamble, the heavy hitters, have been increasing their dividends for decades. As your portfolio grows, so will your dividends. So, let's wrap this up. If you're relying on pension income, Social Security, and dividends in retirement, you want to minimize taxes while maximizing your dividend growth. The key is strategic planning. Use tax-efficient withdrawal strategies. Delay Social Security if you can. Invest in tax-advantaged accounts, and take advantage of qualified dividends. If you found this video helpful, hit that like button, make sure to subscribe, and don't forget to share it with your friends and family who could use these tax-saving tips. Because hey, who wouldn't want to pay fewer taxes and grow their income in retirement? Thanks for watching, and remember, retirement doesn't have to be stressful. Just follow these strategies, and you'll be cruising through tax season with a smile on your face. See you in the next video.